Please welcome back and take your seat. Let me introduce Dr. Hak Bin. Dr. Hak Bin is the head of Emerging Asia Economics, Bank of America Merrill Lynch. He joined Bank of America Merrill Lynch Asia Pacific Economics Research Team in September 2010. He has more than 10 years of experience in economics and equity strategy. Prior to this, he worked as equity strategist at Citigroup, based in Singapore. In his current role as head of Emerging Asia Economics, he has been developing and communicating the regional economic view to key clients and oversee the region's economics of Bank of America Merrill Lynch. In 2012, Dr. Hak Bin and team ranked number 3 in the economics category of the Institutional Investor All Asia Survey. Please welcome Dr. Hak Bin from Bank of America Merrill Lynch.
Yeah, thank you. Yeah, I'll be focused more on the ASEAN 5 economies. I guess given it's been a rough couple of months, so we'll be going through some of our views on what we think are the key issues, risks, and which countries look more vulnerable. I guess I'll start. It's obvious that when you look across the ASEAN markets, the stock market, the currencies, the bonds, they've been under a lot of pressure this year. After 3-4 years of outperformance, you can see here from the performance of the markets. Not counting today, Jakarta, Thailand are all down very sharply. The bond yields are especially sharp for Indonesia. In fact, today, crossing 9% on a 10-year bond yield, and the currency sell-off has been quite tremendous on the ringgit and rupiah. So quite a big rocky start for the second half. And I guess one of the big shocks that's been happening is the slump in exports. And we've seen in these figures that despite some signs in the US of a recovery and so on, that hasn't really shown up in terms of Asian exports. I think that will be quite key of when things will start to stabilize. But as it stands right now, Asian exports generally has been under some pressure. And I think there are two key shocks that we're highlighting that's aggravating the situation. One is basically China's slowdown, which has led to a sharp slump in the commodity prices. This is a plot of the current account positions for Asian countries 3 years back, and basically the change in the current account position in relation to the importance of exports as a share of commodity exports. And it's very clear that who are the 3 big commodity players within Asia. It's Indonesia, Malaysia, Thailand. So it's no surprise that when you plot the change in the current account positions that they've seen the biggest deterioration, right? We've seen Indonesia slip into a huge deficit in the second quarter, 4.4% of GDP. Thailand is in a current account deficit position. Malaysia's current account, 1.1% surplus, is the smallest surplus since the Asian crisis. I think I'll turn this off, sorry. I think it's So this is interesting because I think when you look at the second quarter GDP data, there's a bit of a divergence between the commodity guys and the ones that are non-commodity. Basically, growth in Korea, Singapore, Taiwan, kind of surprised on the upside. So there's a bit of a divergence between the manufacturing exporters versus the commodity exporters, whereas we've seen downside surprises from Indonesia, Thailand, technical recession, Malaysia's GDP growth as well, very weak in the second quarter. So this is something, and it's consistent with this commodity boom story. I mean, another way to look at it is basically, when you look at a chart for Indonesia's current account deficit position, Indonesia has been benefiting from a 7-year boom, essentially, where coal prices went through the roof, palm oil prices and so on. So we had a comfortable current account position for 7 years that drove growth closer to 7%, and basically handsome surpluses, handsome stock market gains. And then suddenly in the last 2 years, we've seen a huge collapse, right? No surprise, coinciding with a 70% collapse in coal prices, for example. Coal is the largest export commodity item for Indonesia, about 15% of exports. Palm oil, the third largest commodity item for Indonesia, 5% of exports, has plunged about 40%. So we've seen this significant deterioration. And I guess in our view, that's that's a permanent in terms of trade shock. That's not going to go away because we don't believe that China is going to come back to the rescue, introduce some great stimulus, and ramp up commodity prices that they did in 2008. So for us, this will result in a permanent exchange rate depreciation of the rupiah, which is required before some improvement. So that's sort of the Indonesia case. We've seen the rupiah come under tremendous pressure. Today I think it was touching 11,500. And I guess compounding that issue that we just spoke about is that a lot of countries in ASEAN in particular have fuel subsidies, right? Thailand has diesel subsidies, but Indonesia's fuel subsidies are very large. At one point, it's about almost 4% of GDP. Malaysia's fuel subsidies is about approaching 3% of GDP. And if they didn't hike on late June, the 44% increase in fuel prices, the fiscal deficit could have gone to about 4.5% of GDP, right? So that forced the Indonesian government to react because there is a constitutional limit in Indonesia that the fiscal deficit cannot exceed 3% of GDP. So we've seen that adjustment, and that hopefully will bring the fiscal deficit below that constitutional limit of 3%. The revised budget has it about 2.5%. Right? But this introduced another issue because now there's a tremendous inflation shock in Indonesia. The last reading was 8.6%. We'll get the next inflation reading for August in a week's time. But it looks like the markets are betting on a 9% reading. The BI was guarding for a lower reading, but it looks as if the inflation surprise is on the upside again, which I think will again force the Bank of Indonesia to tighten more aggressively going forward. So that's the kind of situation. Again, how is the fuel subsidy in this country related to the current account deficit? Well, because you keep gasoline prices artificially low, people don't respond. And essentially the oil imports for Indonesia, which is the red line, has been going up the roof as you sell more cars and so on, and eating up, in some sense, the export revenue that's possible. Right? So the oil deficit has been swelling up for these countries. And you can see the oil deficit going up to a substantial amount, closing on to 3% of GDP for Indonesia before the recent fuel price hike. So this will be part of the adjustment. The hike in fuel prices that we saw in 2005 and 2008 will help reduce the oil trade deficit. It's just that the amount of the improvement we see in the oil trade deficit is not going to be enough to forget about Indonesia going back into a current account surplus. We're just hoping for the current account deficit to go back to about 2% of GDP. But I think the magnitudes that we're talking about from the oil adjustment is probably about 1.2 percentage points. So on top of that, I think the central bank will be forced to having to tighten slow growth to have to manage the current account deficit. It's remarkable that even Malaysia, what is probably one of the few oil exporters, so it's said, is also seeing the same kind of pressure. Because not only has the current account surplus fallen tremendously, 3 years ago, we were talking about current account surplus in Malaysia in a magnitude of 15% of GDP, right? The latest reading is about 1% of GDP. So we're very close to a deficit. And of course, in this kind of market, nobody likes a current account deficit. The countries with current account deficits are punished, especially in an environment where the Fed might start tapering on QE. But the other thing interesting about Malaysia is the net oil position, that it's also slipped into a negative reading, right? One of the few net exporters is also having very generous subsidies. They haven't raised fuel prices for the last almost 2 years now because of the elections, that was just over. And the first part of the year, oil production came down, but also fuel consumption went up, and Malaysia is starting to slip into a small oil deficit as well. So it's very critical on what Malaysia addresses next. We don't think that they're going to do anything until the UMNO Supreme Council elections on 19th of October. I think of course, obviously, addressing hiking fuel prices is not politically popular. Introducing a consumption tax is not popular, and so on. So we would think that after he wins that elections, then only on 25th October might he introduce a budget that focuses more on fiscal consolidation. And then I think we'll see whether the measures are bold enough. So that's kind of the theme, that we've. That's one big shock, essentially the China slowdown hitting commodity prices, a shock that is somewhat quasi-permanent. They may stay for a while, and depending on your views about China, you can talk a good view, or you start worrying if you believe that China's headed for a harder landing. The second shock is this fear about QE tapering. So, I guess we do a very simple exercise. We just went back to the balance of payments data for all the countries in Asia, and we asked who really has benefited from QE flows in the last 3-4 years. Who has seen the biggest portfolio inflows? And when you go through the countries, you look at Singapore, Korea, Taiwan, India, and also the Southeast Asian countries, you're basically going to conclude that the 4 ASEAN countries saw the biggest portfolio flows. And they are essentially the blue line, which is Indonesia, red line, which is Malaysia. So, Indonesia has a pretty steady cumulative foreign portfolio flows that comes in. Even pre-QE was pretty steady. So I think you can argue that it's driven by both, pull factors and push factors. Malaysia, the red line, a lot more volatile because the 2008 episode coincided with a shock election result where, if you recall, the Barisan Nasional, the incumbent party, actually lost the 2/3 control of parliament. But subsequently, it went even more dramatically. In fact, the steepness of Malaysia's inflows was even sharper than Indonesia, largely into the bond market, not so much the equities. The black line is actually Thailand. So Thailand pre-QE was not so great, but actually post-QE was very, very sharp in terms of flows. And then the green is Philippines. A place like Singapore is pretty flat. It's hard to argue that Singapore actually saw that much more portfolio of inflows. So that's one conclusion. If you saw a lot more inflows under the QE period with the risk of QE tapering, there's a possibility of a big unwinding that's just around the corner. We've already seen some nervousness, and QE hasn't even started. Tapering hasn't even started. This is also reflected in the bond ownership of the various markets. So the foreign ownership of, for example, the green is Malaysia, right? The foreign ownership of outstanding bonds in Malaysia went as high as almost 50%. It's down in the last few months. It's down to about 46%. Indonesia as well is the blue line. It reached about 35%. It's down to about 31%. Thailand is the light blue line. It's in the high teens. Korea is in the mid-teens. So you can sense the kind of, I suppose, vulnerability if some of this pull out. And yet, despite this recent sell down, with the spike out in bond yields, how much is left? And I think the answer is that actually not that much yet, right? I think that's the concern, that even despite the sell down, a lot of money that's been parked in these markets, we've only seen a modest amount of outflows. So to that extent, on what your views are about the U.S. Treasury yields, there could be still a lot more outflows, and the pressure could persist for longer. It doesn't help that I guess our U.S. rates view is pretty aggressive. Our U.S. rate strategist Priya is looking at the U.S. 10-year at 3% this year, but she's calling for 4% end of next year, right? So, in that kind of a condition, it's going to be quite tough, I think, for the bond markets in Southeast Asian markets. I mean, there are some details on the figures, but I think the other two conclusion is that when you go through the data is that when you look at equity and bond inflows that's come into the markets, I think the very key conclusion is that most of the inflows during the QE was into the bond market. It was 3 to 4 times larger than the equity inflows. So I think you've got to watch what happens to the bond markets to get a sense of the yields financing costs that happens. We also look at the reserves data to get a sense of how did central banks react during that time to this rush of capital that came in. And I think the interesting conclusion is that for Indonesia, the reserves went up, but in comparison to the amount of inflows, it was like 20 billion less, for example, right? So whereas a place like Philippines, there was a huge amount, 27 billion of inflows, but the reserves over that period went up by 47 billion, right? So Philippines, for example, has built up a bigger amount of reserves to deal with any capital outflows. And even in the most recent months, they've actually used very little of the reserve to deal with the outflows, whereas Indonesia has intervened a lot more aggressively. For Thailand, it's a comparable. The amount of inflows that came about coincided with almost the same increase in the reserve numbers. Right? So which is a comfort. I think we heard from assurance from Governor Prasan that the built-out of reserves gives you as an insurance against the threat of outflows and gives you a lot more flexibility in dealing with the pressure on the currency. I guess on the side is Japan's QE and how this matters. I guess we see Japan as having 3 channels of transmission. One is this just straight yen depreciation. Second is if you believe that Japan is actually going to reflate, and succeed in about 1 or 2 years' time to grow at a 2-3%. And third is this portfolio rebalancing, that's going to shift from all this cash stuff that the households have in banks to the more risky assets, including ASEAN equities or bonds and so on. And I guess when we ask that question, it looks like as if Japan exports are doing pretty well. No surprise given the sharp yen depreciation. And to that extent, I think the countries which are sort of satellites of Japanese production should benefit. So Thailand, I think, will stand out. A lot of the production FDI from Japan has gone to Thailand, Vietnam, to some extent to the financial sector in Singapore as well. If Japan does succeed in reflating, you can see that the economies like Malaysia, Singapore, Thailand, Vietnam exports a bigger share of their GDP to Japan. And Thailand as well is pretty important in terms of the Japanese tourism. If there is a more spending from Japanese tourists. And lastly, if you believe that there is a huge shift into more risky assets, the Japanese have tended to invest more conservatively into the investment grade assets in Korea, Malaysia, Singapore, and especially in the bond market. I guess the other observation about Japan is that actually, when you look as a whole over the last 10 years, most of the money actually didn't come to Asia. In fact, Asia, in terms of portfolio outflows, less than 5% came to Asia. So that's something to bear in mind, that that most of the assets still went into the US and Europe. In the conversation with the IMF, I think it's one interesting observation about the Japan QE that the Bank of Japan regulations actually have a lot of restrictions on what the banks and insurance companies in Japan can invest in. So a lot of them, they cannot take direct stakes in equities and bonds and so on, but they allow them to take stakes in related companies. So actually, that's starting to show, because I suspect that part of the QE idea is that your currency is probably going to weaken. You might want to invest abroad to get away from that currency risk. And we've seen Japanese interest in Indonesian and Thailand, banks increase. Bank of Ayutthaya is one example. But I think because of this push for QE and some of these regulatory restrictions, I think those interests will increase. So I think that's one beneficiary of the Japan QE kind of channel. And of course, we've been getting the questions as well. With the yen, having fallen so dramatically, has investment interests in ASEAN dropped, in particular on the FDI side? And I think the answer is really no. That the FDI interest in Thailand in particular, but also in Vietnam and Indonesia, it showed up in the second quarter figures as well, that the Japanese FDI interest is still there, despite the weakness of the yen, which is encouraging, which is helping to finance, if required, some current account deficit positions. I think one of the key things of where we're calling for stabilization and for Indonesia and all that is really on the U.S. recovery, right? Because this call about the U.S. recovering, that's why the Fed is tapering. And I guess the ironic thing is that we haven't seen that U.S. recovery translate into stronger Asian exports. There's glimpses of data out of Korea, maybe the port statistics in Singapore. But as a whole, we haven't seen much of that. And in large part, the recovery in the U.S. is driven by a housing recovery. Construction hasn't really translated into retail sales being very strong, imports of capital and equipment very strong. So we hope that by next year, that will be a lot more visible, hopefully by late fourth quarter, actually. Our U.S. team is, so I would look at the import growth numbers from the U.S. The U.S. import growth is only 2%, right? It's kind of running below GDP growth. But our U.S. team is forecasting 6% for next year. So it's hard to believe that if the U.S. does get closer to 3% growth, that wouldn't translate to Asian exports, that would help, that would help with the current account positions and hopefully as well stabilize the Asian currencies. But that's something we're still watching for. So, I mean, one way we've been thinking about it, this is who wins, who loses in Asia. If one scenario is that China is on a slower growth path, the signals from the Chinese government is that it's willing to accept a slower rate of growth. It's not going to introduce any great stimulus, whereas the U.S. is recovering. The winners, the beneficiaries of a U.S. recovery is different from the beneficiaries of a China recovery, right? The beneficiaries of a China recovery are the commodity guys, the likes of Indonesia and so on. The beneficiaries of a U.S. recovery tends to be more the manufacturing export guys, the Korea, the Singapore, Taiwan. So, you can play around with scenarios and see which ones. And that is sort of what we're seeing in the data, that the manufacturing exports are doing a lot better than the manufacturing export side. I guess our call for China, just as a backdrop, is that it's stabilizing. Our economist Ting Lu is forecasting 7.6% growth this year and next year. So he thinks that there are signs that growth has picked up from the lows, and I suppose that's sort of reflected in the recent outperformance in the markets. Some of the themes that we're looking out for are that the abolishing of the one-child policy, urbanization, some of the financial sector reforms will continue, hukou system reform, fiscal reforms, renminbi internationalization. So some of this will help ASEAN. But I think one of the, I guess you have to think about the links with China, with the rest of Asia, which we sometimes get queries with. If China does heartland, is it going to be as dramatic as what we saw in terms of the US and so on? So it's important to bear in mind that with China, the trade links are the strongest, right? Because for a number of countries in Asia, including like Thailand, China has become the largest market. That applies as well to Malaysia. That applies as well to Japan, Taiwan, Korea, Hong Kong, so a lot more in the Northeast. China has become the largest market, even though China is 8.2 trillion in terms of GDP, right? The US is actually about 16 trillion. So China is still almost just slightly more than half the US size, but it's become a major ex-market. Some of this probably overstates China's importance because a lot of it goes to China, reprocess, and re-export to Europe and the US. There's even some studies that show that as much as 40% of the trade with China is in fact intermediate, goods to be reprocessed. And then the final demand is elsewhere. But it's important to notice that the other links are actually very weak with China. Things like direct investment in ASEAN is actually very low. China actually invests very, very little. Perhaps larger for some of the Indo-China countries, perhaps a bit more noticeably for Cambodia and so on. But with the rest of ASEAN 5, it's actually quite low. Those I think throws out interesting dynamics. China FDI into Thailand, for example, is 0.1%, right? You look at a number from Japan FDI into Thailand, for example, is like 1.2%. It's 12 times larger. So it's important to just bear in mind some of these other links and the relationship between the different countries. But I think the most important event for the rest of ASEAN is actually China's demographics. I think what is interesting is that wages in China is rising dramatically, and that's having quite an impact. This is basically, I think the government has confirmed that the labor force started shrinking last year for China. So China's demographic boom is a lot smaller than what the rest of Asia went through. I think the typical demographic boom, that Singapore, Korea, Taiwan, a lot of countries went through was about 45 to 50 years. China basically had it for 30 to 35 years. And that's because of the one-child policy. The one-child policy shrunk that window, and that's why the saying that in China, they never had a chance. They basically got older before they got rich. Whereas a lot of countries at least had a chance to get rich before they got old. And I guess when you work out what implies in terms of potential growth is going to be like for China, well, our view is that China is going to be sliding towards 6% by the end of this decade. When you go through the demographics, the working age population shrinking, you basically can slice off about 0.1 to 0.2 percentage points a year. So I think that's kind of the backdrop that we should be accepting. So I guess why is this important? I guess one is just looking at in terms of the demographic divide that's going to emerge. I think the point is when we look at the last 10 years, almost all of Asia had a demographic boom, except Japan, right? Even China, Korea, everyone had a demographic dividends. Our point is for this next 10 years, that's not the case. The next 10 years, we're going to see, well, Japan is going to be shrinking, but we're going to see China's working age population shrinking. We're going to see Korea working age population shrinking. Thailand we're going to see working age population shrinking as well, according to the latest UN data, and Hong Kong and so on. So a bit of a divide between North and South. Whereas the guys who's furthest, in terms of demographic peaks, it's going to be the Philippines. Indonesia is now second. India is third. These are the countries that will have the big labor surplus in terms of the population. So these are the details of the ranking, of the various countries, and you can see that we're approaching those turning points. And I guess the question is, does this matter? Is demographics related to potential GDP growth? And I think chances are it's probably correlated pretty closely, right? Especially, and the concern is with the Japan experience that we've seen how demographics and the dependency ratio, as it rises, can weigh on growth, can weigh on property prices. Property prices and land prices in Japan has more than half. It can weigh on bond yields. At the start of the peak in Japan, bond yields was 2%. Now it's close to zero. It's interesting that when I look at Korea, in a world of QE and where the central bank has been easing rates, Korea's real estate prices are down like 6-7% from the peak in Seoul. That Korea is also starting to see some of these pressures emerge. So it's going to be an interesting time because we're going to have this big divergence across Asia, and I think it would matter. We do a very simple exercise. We just ask ourselves, who is going to see the strongest labor force growth in this coming decade, from 2013 to 2023? We don't try to do it ourselves. We go to the UN data. They're the authority on demographics. They have they have estimates of the working age population. They recently did the revisions about 3 months back, and this is the ranking. They see Philippines growing at 21%, Malaysia at 15%, Indo at 15%. Singapore is because of the immigration. Singapore will be down here if it was left to if its own citizen dynamic. But essentially, we have this divide, and then you got negative numbers for China, Thailand, Korea, Hong Kong. Thailand's an interesting case because it will be essentially the only ASEAN country to actually see the labor force, the working age population shrink. We just had a session on some of these issues, and there are already concerns about tightness in the labor market, shortage of workers, and that's why I think Thailand has to leverage on the opening up of Myanmar. Right? Thailand's a lot more open to foreign workers than, say, Japan or Korea. Right? In Korea, I think only 1.5% of the population is a foreigner. Similar to Japan. So Thailand can mitigate that by, I suppose, staying open to foreigners. But still, this will be a tremendous pressure, and it also raises the question of what is the potential growth for Thailand, going forward. Will it be closer to 4%, in fact, in the coming few years because of this dynamic? This is a plot of the GDP growth and the demographics, in the last decade, and I think clearly there is a pretty good correlation. In fact, the correlation is so clear when China is dropped out. China joined the world later, when it increased, and the productivity growth and the catch-up basically made the potential growth for China that much more higher than what is seen. But really, with China shrinking in terms of the labor force, the potential growth for China could be sliding down, to what is a more normal relationship. This is the stock market correlation, a weak correlation in terms of the stock markets and demographics. But I guess the other thing is the rest of Asia is really affected by China because China is the big elephant in the room. China's labor force is 900 million, population 1.3 billion. And when China joined the world, China basically depressed wages across the world. So this coincided with a lot of problems. The medium wage stagnation phenomenon in the U.S. Income inequality started rising. In part, also, companies started outsourcing the production to China. There was a horizontal labor supply curve that seemed infinite at that time. But now, this is the wage rate for China, right? China's wages are rising at about 20% a year. Sure, ASEAN growth rates wage has been rising, but they've been rising in the low teens. So, I think 5-10 years ago, you read a lot of this news, China was eating everybody's lunch, right? Everybody was fearful that, ASEAN will be marginalized and ASEAN will lose out. And what has happened suddenly is that you hear more stories about labor shortages on the coastal areas in China. Some production is even shifting back to the US, coming back to ASEAN. So I think that's quite a key difference. What also means that the labor supply curve for China has turned vertical, that the wage pressures has become more intense. This is not going to go away. It's partly structural. And we see that in terms of FDI behavior, right? Because for 5-10 years ago, this is China FDI, and this is a stacked up of ASEAN FDI. And you can see, I remember Singapore having a bit of a self-searching episode in this part of the time because, FDI was starting to dry up. Growth was all very much focused on China. And then suddenly, the last few years, FDI has just surged within ASEAN. Because I think basically the price of labor has gone up tremendously, and the pool of labor now is at ASEAN's advantage. We've seen a tremendous increase in investment in Indonesia in particular, but Thailand as well, and now increasingly in the Philippines. My guess is that this would persist, and there's a chance of China's FDI sliding and ASEAN remaining fairly high. I guess related to this, it doesn't help that the China-Japan relationship is not at its best. The tension since the middle of last year when, the riots happened, the Japanese shops in China there was some burning and so on with the dispute over the islands. So Japan's shift towards and away from China is very obvious. Right? This is the red line now, Japan FDI into ASEAN. It's been rising, whereas I think the investment in China will probably remain pretty flat. So I don't think this political issue is going away, and some of those countries are beneficiaries. Which countries does Japan like best? Well, I think when you look at FDI data, it's very obvious it's Thailand, number one. Second, Vietnam. It looks to be a very popular country now. But the surprising one is the third would be Indonesia. Indonesia from Japan FDI up 30-40% this year. In fact, the second quarter data for Indonesia, there was one bright spot. Besides the current account deficit balloon, the single services deficit balloon, the income deficit balloon. But on the capital account for Indonesia, the FDI still went up, which is encouraging. FDI for Indonesia now is slightly above 2% of GDP. So that's the encouraging trend. That's why if you just reduce the current account deficit to about 2 to 2.5%, I think that's an acceptable level of deficit because the FDI tends to be pretty stable. It's not volatile like portfolio flows. I guess the other surprising development was actually U.S. FDI. We've heard about this. Hillary Clinton's famous speech 2-3 years back about this pivot towards Asia. But I think what's striking is that FDI in last year into ASEAN 6 actually rose, some 40%, which is pretty encouraging. At a time when the U.S. growth seems to be struggling. So we'll just continue. We've seen President Obama come around several times to Asia. I guess the stepped-up military engagement is partially to manage China's rise. But it's very obvious that when he's visiting Asia, he seems to be paying a lot more attention to the ASEAN countries this time, right? In fact, this time visit, I think in October, he's going to Brunei, Indonesia, and Malaysia. Right? I think for the sake of time, I will move on a bit more quickly. I think this is the other important development, in terms of the demographics, which relates to the current account positions of the other countries and remittances. That basically the price that's going to be increasing in the coming years is, we had a decade-long boom in commodities. So Indonesia is the commodity exporter, and Indonesia benefited from being, rich in commodities. But it looks like the price that's going to go up in terms of resource is the price of labor. And who is the exporter of labor? Countries like the Philippines, for example, right? And one of the reasons why the Philippines' current account surplus actually went the other way. Everyone's current account position got worse into a deficit, but the current account position for the Philippines went from a 2% surplus to a 4% surplus last year because of the remittances, where remittances now is about 10% of GDP, right? That's a pretty good buffer. It provides basically hard foreign currency for the country, and it makes it a lot less vulnerable in terms of the to outflows. Related to that, actually, Vietnam increasingly has a large share of, in terms of remittances to GDP as well. I won't be surprised if India, 5 years from today, the remittances flows will be large enough to close the gap of that current account deficit. Now, increasingly, even though there's a huge in absolute amount of remittances into India, 63 billion, the share of GDP is still, over 3% of GDP. So it probably won't be the fiscal reforms in India that closes that deficit. Is again, I guess the second best scenario of not attracting FDI, but actually ending up exporting the workers abroad, and then the workers, sending money back into the country. This just makes the point about the current account position of the Philippines, and I think the point is, we just saw the demographics for the Philippines. My guess is that this is going to continue, right? This is not going to stop because the labor surplus is still very much is still going to be very large in the Philippines. It is interesting because when you look at unemployment rates for a lot of these countries, they're all falling, right? Thailand's very low unemployment rate. Indonesia's unemployment rate has been falling now closer to 4%. 2 years ago it was 7-8%. The Philippines grew at 7.8% in the first quarter, yet the unemployment rate went up, right? So I think that's exactly our point, that despite growing faster than China in the first quarter, that they got so many workers that the wage pressures are still not very obvious, and that's why inflation is still somewhat controlled. Wages are rising in the teens in the Philippines despite this boom, but we saw a wave of minimum wage increases this year across ASEAN, right? The most obvious is Jakarta. Minimum wages went up 44%, on average 20 to 30% across a lot of provinces. Minimum wages went up 30% in Thailand. Vietnam, 25%. Malaysia introduced minimum wages for the first time. East Malaysia, 30% up. West Malaysia, 20% up, right? So it's interesting that some demographics are affecting some inflation dynamics as well. I guess lastly is the balance sheet. We'll be getting a lot of queries about balance sheet because of the currency weakness, because of the current account deficit. Naturally, you get questions about, is this like the ASEAN crisis in '97? What has happened to leverage positions? So this is like a summary. I know it's hard to read without binoculars, but I guess I'll make several points. One is that when you look at the public debt leverage levels of Indonesia and the Philippines, they've really gone down dramatically over the decade. So like Indonesia's, and that's why I don't think it's like the Asian crisis. It's not going to be a leverage or a banking crisis. It may be a balance of payments crisis. Indonesia's public debt is 24% of GDP. It's gone down. You go back to '97, it was as high as 70% of GDP. It was closer to Greece. It's come down a lot. Foreign currency debt has gone down to 13% of GDP. You don't have the kind of foreign currency exposure. External debt, 28%. Same with the Philippines. There's been general deleveraging on the public debt side, and also on the foreign currency debt side. We've heard a lot of noises about Thailand's household debt. At the last panel discussion, we heard about this number. The BOT released 77%, and I guess this sort of stands out for Thailand. Racing up from 5-6 years ago from 48% to 77%. 77% is comparable to the household debt ratios in Singapore, Hong Kong. Is this a worry? I guess we have to watch this. Bank of Thailand has expressed its concerns. Bear in mind that not all of this is with the banking system. About 41% is the banking system. A lot of loans is through the government and state banks. And then the other point is that you can argue that some of this blip is temporary. It was because of the home ownership scheme, car ownership scheme. So there was a front loading of debt, for the purchases this year. So this year there should be some tailing off. There's also some argument that this is also mixed up with investment loans, right? These are some of family business borrowing for the farmers and so on. So, but still, I guess the rate of increase is somewhat of a concern. The country, I guess, that really has leveraged up most noticeably is Malaysia. Malaysia's public debt, 54%. Malaysia actually has a self-imposed limit of 55%. So public debt has gone the other way. Public debt for Thailand is low, right? We heard from the finance minister this morning, 44%, which is this number here. Malaysia's household debt is actually now 83%, this number. I'm running out of battery here. So, and I guess the other point I would highlight for Malaysia is the quasi-debt, which is, I mean, maybe the BTS system in Thailand here, it goes on the government balance sheet and you can see the leverage going up. In Malaysia, it's undertaken by a private company that issues bonds, which is government guaranteed, which is off balance sheet. So that's not captured in the blue line, public debt, and essentially, it's captured by the red line, which includes government guarantees. And when you include that figure, so things like Iskandar infrastructure, which is in Johor, is also under a private vehicle, which is government guaranteed. Tun Razak Exchange, 1MDB bonds, and so on are all off balance sheet. I guess when you include all the off-balance sheet stuff, the public debt for Malaysia is rising at a much steeper rate. So I think that's something we're mindful of, and that's why it's pretty important that the Prime Minister addresses this in the budget in October. And that's why the Fitch essentially gave a negative watch in terms of ratings for Malaysia. These are just comparisons with the Asian crisis. If you go back, the other important, interesting thing about the Asian crisis was the foreign currency leverage, right? If you recap, 15 years ago, there was this huge amount of borrowings in foreign currency because they were cheap, right? Just like U.S. interest rates were very low, but then the banks landed in the local currency. And I think the encouraging thing is that when you plot in terms of some of this is not captured by the national accounts. You have to go to the BIS data, which gives a consolidated figure for all the claims by all the foreign banks of how much these various countries borrow in US dollars. And when you plot that figure here in ASEAN, in absolute terms, they've been going up. But in terms of the percentage of GDP, it's been pretty flat. So there is this reduced reliance on foreign currency loans that has not really noticeably appreciated over the last few years, which is a good sign. There's been a lot of concerns. I've been getting a lot of concerns about Indonesia in particular, because there were signs that certain corporates had borrowed heavily in US dollars. So the other thing is about corporate leverage. Corporate leverage generally has been rising across Asia. It's been driven in large part by China in more recent years as well. But ASEAN has also picked up here. I guess the next chart will show for ASEAN. So I think we've heard about the lessons from the Asian crisis. So generally, corporates in ASEAN has been pretty conservative. If you extended this line to the Asian crisis, it'll be somewhere like 80%. It's come down. And then in 2008, 2009, it kind of bottomed out. And the last 3-4 years, it's been kind of going up again. Not to the levels that we saw pre-Asian crisis, but they've gone up about 10 percentage points. So some signs of leverage up, but I don't think to the levels that are totally worrying. There's been also some switching. What's important since the Asian crisis is the development of the bond market. So the risk has been taken off, in some sense, away from banks. So we've seen this in particular for Thailand. If you look at the corporate leverage and you divide it into the part that comes from the banking system and the part that comes from bonds, you can see that the corporate loans as a share of GDP for the banks have actually dropped. But the risk has been shifted to the bond market. Right? I guess I took off the oil price slide, but I guess given what's happening in Syria, there's been some concerns now with the oil price shock. And I think the bottom line is that Asia as a whole is a net oil importer, so a rise in oil prices is generally bad for growth, it's bad for inflation. When you rank it, Thailand is seen as one of the vulnerable ones to that price shock. So it depends on how it plays out. And I guess the other thing that we have to watch now is also that oil prices also aggravate the fuel subsidies. At a time, if the countries have a fuel subsidy and the price doesn't adjust, instead of showing up in inflation, it shows up in the current account deficit. Right? So we just have to bear in mind that if today the Brent broke 115, that it could worsen the current account deficit in Indonesia, for example. It could negate the benefits of the fuel price hike in the first place. So something we have to watch quite closely. In fact, that's exactly what happened in 2005 in Indonesia, if you recall, because there was a double strike for Indonesia. At the time, they hiked the fuel price by 33%, but global oil prices started raising up. So the current account deficit never closed. And then they were forced to hike 5 months later with a 80% fuel price hike. Sun inflation close to 20%. Yeah, so it's a dynamic that's not pleasant, and I suppose that this oil price shock is coming at a bad time for certain countries. Maybe I'll stop there, and if there are any questions, I'm happy to take them. We've just got 2 minutes.
If there's any question in the house, do raise your hand. We'll bring a microphone to you. Yep, coming over. State your name, please.
Sure, it's John Fu from Kingsmead. I had a question on ASEAN, given the press of the capital withdrawal and the currency, and over the medium term, the demographics look very, very good, and the Japan FDI is a big positive. Over the short term, let's say the 6 to 12 months, given tapering is coming, what's your bear case for ASEAN? I mean, how bad can things get in terms of currencies and capital flight?
I guess if you really want to draw up a bear case, you can see that the currency could still be vulnerable. Take for example for Indonesia. I'm looking for signs of stabilization in inflation, in the current account deficit, and in the reserves data. Right. So the inflation has spiked up, right, from 4% to 8.6%. I think everybody was hoping that it would start peaking out 1 or 2 months later. But now we're going to get a second leg in terms of inflation surprises because of the exchange rate depreciation, right? Historically, we've seen a big pass-through, from the currency to inflation. So you can see it hitting 10%. And then if this oil price thing is going to get out of hand, you can see the rupiah continuing to be under pressure for the next 3, 4, 5 months. So I think there's a concern about when exactly inflation peak. There's a concern about whether the current account deficit will really improve as much as we hope, because we saw measures in India, for example, not really helping very much. Current account deficit was 4.4% in the second quarter. The central bank is actually pretty optimistic that it will fall to below 3% to 2.7% by the third quarter. We're not so optimistic. We think it will have a small impact. There will be some impact. But chances are, will markets be sympathetic to a current account deficit that's closer to 3.3, 3.5% of GDP? Probably not if the Fed is really going to start tapering in the coming months. So our guess is that it's still going to be pretty rough, probably for the duration for the next 3 to 6 months. And the worst kind of scenario is that the Fed tapers, but the U.S. growth recovery is actually pretty weak, right? The hope is that the Fed is tapering on the precondition that growth actually turns out to be all right, which should help Asian growth, which should help Asian exports, which should help the current account positions of some of these countries, and which also stabilize the currencies. So I guess the worst case is that if there is a mistake in judgment of premature QE tapering, exactly at the wrong time. So far we have very little evidence that the U.S. recovery is translating into stronger Asian exports. I think that's a concern on my side. And again, aggravating with that is that the policy options for certain countries is being constrained. I think obviously Indonesia stands out, right? In Thailand, you don't have an inflation issue, right? So you don't have to react in terms of, and you can let exchange rate adjust. But in Indonesia, inflation is sky high. So at a time of slowing growth, Indonesia has to tighten, right? And that will aggravate the slowdown. In Malaysia, we see that constraint on the fiscal side. Public debt is high and rising, and it's very clear that the rating agencies are not happy. So at a time when growth is slowing, they may actually have to deduce new taxes, the consumption tax, a hike in fuel prices, talking about property tax, which is, again, negative for growth. So I think sort of constraints also has to be seen in some of these countries. Hope that helps, John. Thanks. Okay, I think I'll call it there. Thank you. Thanks.
Well, thank you very much, Dr. Chua Hakbin, for the very active and very informative session, I would say. Once again, may I ask Dr. Chua Hakbin to stay on the stage just for a few moments for the photo session. All right, thank you very much, all of the distinguished guests, for participating in Thailand Focus 2013 today, which is the first day. There are a number of interesting seminars lining up for tomorrow's sessions. The first session will start at 9:15. So hope to see you, everyone. Have a good day and see you tomorrow. สวัสดีครับ